A key factor influencing the economy's response to rate hikes is the amount of debt that is fixed rate. During this recent rate hike cycle, the economy was less sensitive to rising interest rates than many had expected. Initially, back in 2022, it seemed like the economy would feel the impact of rate hikes more sharply. However, by early 2023, it became clear that the economy was more resilient or desensitized to rate hikes than anticipated. One significant reason for this is that the US now has over 100% debt to GDP, and fiscal deficits have grown larger than bank loan creation in a given year. This marks a shift from a credit driven economy to one more dominated by fiscal policy, what some refer to as fiscal dominance. In this context, federal debt plays a crucial role, especially since much of it is relatively short term. Although the average duration of US federal debt is around 6 years, a considerable portion of it is front loaded within the first few years, with some extending out to 30 years. This structure has helped cushion the immediate impact of rate hikes on the broader economy, delaying the full effects of tighter monetary policy.
The economy's resilience to recent rate hikes is largely due to the structure of its debt. Initially, many expected the economy to be more sensitive to rising rates during this cycle, but by early 2023, it became clear that it was more desensitized than anticipated. One major reason for this is that the US now carries over 100% debt to GDP, and fiscal deficits have grown larger than annual bank loan creation. This marks a shift from a credit-driven economy to one more dominated by fiscal policy, a phenomenon known as fiscal dominance. Federal debt plays a critical role. A significant portion of this debt is relatively short-term, with an average duration of around 6 years. However, much of it is front-loaded in the first few years, with only some extending out to 30 years. This short-term structure has helped cushion the immediate effects of rate hikes on the economy. Essentially, the heavy reliance on short-term debt has allowed the government to manage its obligations more easily in the face of rising interest rates, delaying the full impact on the broader economy. While this has provided temporary relief, the underlying fiscal challenges and the reliance on short-term debt remain critical concerns. As the fiscal dominance scenario continues, the interplay between debt, interest rates, and economic growth will remain a key factor in shaping the future economic outlook.
Subscribe our channel and press the bell button to get our video notification. And like the video.
In the 2010s in the United States, we saw patterns similar to what Japan has experienced over a longer period, particularly in terms of how deficits and public debt have played out. When people look at Japan, they often wonder why, despite large deficits, high public debt, and a growing central bank balance sheet, there hasn't been more inflation. The answer lies in Japan's exceptionally slow broad money growth over the past 2 decades. While Japan's public sector was expanding its balance sheet, the private sector was deleveraging, meaning that broad money supply was effectively being destroyed by the reduction in private debt. For example, if the government is running fiscal deficits of 5% per year, but the private sector is reducing debt by 2% annually, the net effect might be something like 3% annual broad money supply growth, just enough to avoid significant inflation, which is what Japan saw. This dynamic highlights how the unwinding or stagnation of a private debt bubble tends to be disinflationary as the shrinking private sector offsets the expansion of the public sector. However, once much of the debt has been transferred to the public ledger, the situation changes.
In the 2010s in the United States, we began to see a pattern similar to what Japan experienced over several decades: large public deficits and growing debt, without the expected high inflation. Many people wonder why, with all that public debt and central bank balance sheet expansion, Japan hasn't seen more inflation. The answer lies in the relationship between public sector expansion and private sector deleveraging. Japan had some of the slowest broad money growth in the world during this period, and that's because while the government was running large deficits and monetizing debt, the private sector was reducing its debt load. when the private sector deleverages, essentially paying down debt or not borrowing as much. It actually reduces the overall money supply. For example, if the government is running a 5% fiscal deficit, but the private sector is reducing its debt by 2%, the net effect might only be 3% growth in the broad money supply, which is particularly inflationary. This phenomenon of private sector deleveraging balancing out public sector expansion creates a disinflationary environment, as we saw in Japan and to a lesser extent in the US during the 2010s. However, once the debt has largely shifted to the public sector, there's less room to manage these dynamics. At that point, with most of the debt burden on the public ledger, there's nowhere left to kick the can, except into the currency itself, leading to more inflationary pressures as the burden shifts onto the broader economy.
Measures of consumer price index going back to the 1700s and up until around 1940 show that price inflation was minimal. There were periods of inflation when demand outstripped supply, but these were generally balanced by periods of deflation, resulting in a largely stable price level over time. The significant shift began with the advent of central banking, and particularly after 1971. This is when we observed a dramatic increase in CPI, resembling a hockey stick growth pattern. Under a hard money system, like the gold standard, inflation can still occur, but usually under different circumstances. For instance, if there is a war that halves manufacturing capacity, the supply of goods and services decreases while the money supply remains unchanged. In such a scenario, the reduced availability of goods would lead to price inflation even without an increase in the money supply. So while hard money systems tend to limit inflation primarily driven by money supply growth and debasement, they are not immune to inflationary pressures. Major disruptions such as wars or catastrophes that affect the supply of goods and services can still cause significant inflation despite a stable money supply.
Examining measures of the consumer price index from the 1700s until around 1940 reveals that price inflation was relatively minimal. During this period, inflationary and deflationary pressures were often in balance. While there were occasional spikes in prices due to demand exceeding supply, these were generally offset by periods of deflation, resulting in a stable overall price level. The major shift occurred with the rise of central banking, and especially after 1971, when the US abandoned the gold standard. This transition led to a dramatic increase in CPI, characterized by a hockey stick growth pattern. Before this period, even under a hard money system like the gold standard, inflation could still occur under certain conditions. For example, if a war significantly reduced manufacturing capacity, the money supply might remain constant, but the reduced supply of goods and services would drive up prices. This is because inflation can arise from a mismatch between the supply of goods and services and the available money, even if the money supply itself doesn't increase. In a hard money environment, inflation is more often linked to disruptions that affect the supply of goods rather than from the growth of the money supply. Major events such as wars or other catastrophes that disrupt production can cause price increases despite a stable money supply. Thus, while hard money systems generally prevent inflation driven by monetary expansion and currency debasement, they are still vulnerable to price increases caused by significant disruptions in the supply of goods and services.
Subscribe our channel and press the bell button to get our video notification. And like the video.